In 1971, the United States did something unprecedented. It severed the dollar's link to gold. For the first time in history, the world's reserve currency was backed by nothing tangible. 2 years later, Saudi Arabia quietly provided the solution. Every barrel of oil sold globally, whether to Japan, Germany, or Brazil, is priced in US dollars. This arrangement, known as the petrodollar system, has sustained dollar dominance for half a century. But it didn't happen by chance. It was designed to address a crisis. This is forgotten economy, where money, power, and history collide. The petrodollar system is one of the most consequential financial mechanisms of the modern era, yet most people don't know it exists. Understanding how it works reveals something fundamental. Currency power isn't just about economic strength. It's about creating structural demand that never ends. Here's how oil became the foundation of the dollar, and what happens when that foundation starts to crack. For 27 years after World War II, the dollar was backed by gold. Under the Bretton Woods system, foreign governments could exchange their dollars for gold at a fixed rate, $35 per ounce. This made the dollar trustworthy. It wasn't just paper. It represented something real. But by 1971, the system was breaking. The U.S. was spending heavily on the Vietnam War and domestic programs. Other countries, particularly France, started demanding gold in exchange for their dollar reserves. The U.S. gold supply was draining. In August 1971, President Nixon announced the dollar would no longer be convertible to gold. Bretton Woods ended. The dollar became a fiat currency, backed by nothing except the promise of the U.S. government. This created an immediate problem. Central banks around the world held dollars because they could be exchanged for gold. Without that guarantee, the question became, why should we keep holding dollars? If the currency isn't backed by anything, what prevents the U.S. from printing unlimited amounts? What stops inflation from eroding its value? The U.S. needed a new reason for the world to demand dollars. Not gold, not military force, something structural, something indispensable. Oil provided the answer. In October 1973, OPEC imposed an oil embargo in response to U.S. support for Israel during the Yom Kippur War. Oil prices quadrupled within months. Western economies faced fuel shortages, inflation, and economic paralysis. Gas lines stretched for blocks. Industries slowed. The crisis revealed how dependent the modern world had become on oil. But something else happened during the crisis. Even as prices soared, oil transactions continued to be denominated in dollars. Every country that needed oil, and every industrialized country did, had to obtain dollars first. Japan needed dollars. Germany needed dollars. France needed dollars. The crisis didn't weaken the dollar. It reinforced its necessity. Oil is not optional. It powers transportation, manufacturing, agriculture, and electricity generation. Every growing economy needs more of it. Unlike gold, which could be hoarded or substituted, oil is consumed. Demand never stops. The U.S. recognized the opportunity. If oil could be permanently priced in dollars, global demand for the currency would be guaranteed. Every nation would need dollars to function. The dollar would maintain its reserve status, not because it was backed by gold, but because it was backed by the one commodity the world couldn't live without. In 1974, U.S. Treasury Secretary William Simon traveled to Saudi Arabia. The meetings were not publicized. There was no formal treaty. What emerged instead was a durable financial arrangement reinforced by incentives, not legal obligation. Saudi Arabia would price its oil exclusively in U.S. dollars. In exchange, the U.S. would provide military equipment, security guarantees, and access to American financial markets. Critically, Saudi Arabia would invest its oil revenues, billions of dollars per month, in U.S. Treasury bonds. This was the foundation of the petrodollar system. Saudi Arabia was the world's largest oil exporter. Where Saudi Arabia led, other OPEC members followed. Within a few years, the global oil market was almost entirely dollar-denominated. Here's what that meant in practice. If Japan needed to buy oil from Saudi Arabia, it first had to convert yen into dollars. Japan would sell yen on foreign exchange markets and buy dollars. Then it would use those dollars to purchase oil. Saudi Arabia would receive payment in dollars. Those dollars would then be invested in U.S. Treasury bonds, effectively loaned back to the U.S. government. The cycle was self-reinforcing. More oil demand meant more dollar demand. More dollar demand meant foreign central banks needed dollar reserves. More reserves meant more Treasury bond purchases. More bond purchases meant the U.S. government could borrow cheaply and run deficits without triggering a currency crisis. This is how the petrodollar system works, not through coercion, through mutual dependency. The petrodollar system created something unusual, a structural subsidy for U.S. debt. Under normal conditions, a country that imports more than it exports, running a persistent trade deficit, would see its currency weaken. Investors would lose confidence. Interest rates would rise. Borrowing would become expensive. But the U.S. runs a trade deficit year after year, and the dollar remains strong. Here's why. Even though the U.S. imports more goods than it exports, dollars flow back into the country through Treasury bond purchases. Oil exporting nations accumulate dollars and reinvest them in U.S. debt. Oil importing nations hold dollars in reserve to facilitate energy purchases. The result: consistent demand for U.S. Treasury bonds, which keeps interest rates lower than they would otherwise be. This allows the U.S. government to borrow more at cheaper rates than would be possible without the petrodollar system. It's not a conspiracy. It's a design feature. The system benefits Saudi Arabia and other oil exporters by providing security and a stable market. It benefits oil importers by ensuring reliable supply in a widely accepted currency. And it benefits the U.S. by creating permanent demand for dollars and debt. For 50 years, this arrangement has held. But here's what most people miss. The system only works as long as oil remains essential, and as long as participants believe it's in their interest to maintain it. Both of those conditions are starting to shift. In 2018, China launched oil futures contracts priced in yuan, convertible to gold. It was the first major challenge to dollar-denominated oil trading. The contracts didn't replace the petrodollar system, but they created an alternative. Russia began accepting rubles for oil sales to certain buyers. India explored rupee-based trade agreements with oil exporters. Slowly, the assumption that oil must be priced in dollars started to erode. Then came 2022, when the U.S. and its allies froze Russia's dollar-denominated reserves in response to the Ukraine invasion. Something changed. The move demonstrated that access to the dollar system was contingent on political alignment. It wasn't just about economics anymore. It was about geopolitical alignment. Countries that had relied on dollar reserves for stability began reconsidering the risks. If dollar assets can be frozen, are they truly reserves? If the financial system can be weaponized, should we diversify? The BRICS nations, Brazil, Russia, India, China, and South Africa, began coordinating more seriously on alternative payment systems. Their combined GDP rivals that of Western economies. Each has reasons to reduce dollar dependence. This doesn't mean the petrodollar system is ending tomorrow, but the momentum is shifting. If oil begins trading in multiple currencies, yuan, euros, rubles, the demand for dollars decreases. Not overnight. Gradually, central banks would hold smaller dollar reserves. Oil exporters would diversify their investments beyond U.S. Treasury bonds. The U.S. government would face higher borrowing costs as demand for its debt softened. This doesn't mean the dollar collapses, it means the subsidy fades. The dollar is still dominant in international trade, reserve holdings, and global debt markets. 60% of central bank reserves are held in dollars. 80% of trade finance is conducted in dollars. The petrodollar is one pillar of that dominance, but not the only one. Still, losing that pillar weakens the structure. Higher interest rates make debt servicing more expensive. The U.S. government would face harder choices: cut spending, raise taxes, or accept higher inflation. The flexibility that the petrodollar system provided, the ability to run deficits without immediate consequences, would narrow. The transition wouldn't be sudden. Systems this large move slowly, but the direction is becoming visible. The British pound dominated global finance in the 19th century. It was backed by coal, industrial output, and the Royal Navy. Britain ran the world's reserve currency for decades. Then conditions changed. Industrial power shifted. The world wars drained resources. By the mid-20th century, the pound was no longer dominant. The dollar replaced it. Currency dominance is always temporary. It depends on conditions, trade networks, commodity flows, military power, institutional trust. When those conditions shift, so does the currency regime. The petrodollar system was the solution to the problem of 1971. How to maintain dollar demand after gold. It worked because oil was universally needed, and because the U.S. could offer security and markets in exchange for cooperation. For half a century, those conditions held. Now, energy markets are diversifying. Renewable energy is growing. Geopolitical fractures are deepening. The assumptions that built the petrodollar system are under pressure. The question isn't whether the petrodollar lasts forever. Nothing does. The question is, what comes next? The petrodollar wasn't a trick. It was a response to the collapse of Bretton Woods, a way to anchor the dollar when gold could no longer do the job. It created a system where buying oil meant buying dollars, and buying dollars meant funding U.S. debt. That system enabled the U.S. to run deficits, borrow cheaply, and maintain global influence. But systems built on specific conditions eventually face new conditions. The world that needed dollar-denominated oil in 1974 is not the world of 2025. China is now the largest oil importer. Renewable energy is scaling. Digital currencies are emerging. Geopolitical alliances are fracturing. The petrodollar system won't collapse in a dramatic crisis. It will erode. Slowly, unevenly, but persistently. What replaces it depends on whether the world still needs what the dollar provides. If it does, the system adapts. If it doesn't, something else emerges. The petrodollar kept the dollar alive for 50 years. What happens next isn't about predictions. It's about understanding the forces at work and recognizing that every system, no matter how stable it seems, is built on conditions that eventually change.